Welcome to part 2 of my performance review since the beginning of the day trading room. This is part 2 of a 2-part video series. In part 1, I discuss my results with key performance metrics data, as well as how I use Monte Carlo simulation to do forward projection. This video will be about looking at the impact of individual components of my trade management rules to find out how effective they really are. Before we start, I want to quickly explain the importance of having a high recovery factor when trading. This was one of the key metrics discussed in part 1. Recovery factor is calculated by the following formula. This number is very useful if I need to make changes to my strategy. Currently, my recovery factor is 8. If I decide to make a change and other metrics remain relatively the same, then the recovery factor will show me if the change is worthwhile or not. There is no reason to apply a change if it reduces the recovery factor of my results, because it means that the change made it harder for the account to recover after going through maximum drawdown. Let's take a look at the effect of position sizing on my performance. My standard risk per trade is 1%, and I can go as low as 0.5% on trades that I see as high risk. This is a discretionary decision based on what I can see from price action at the time of the trade. Let's take a look at what the numbers really say. Here are the key performance metrics if I had used the same 1% on all trades. No change in overall expectancy as it should be, because the end results are the same. Average win size and loss size have both increased, and as the result, average win to loss ratio have dropped. Key differences would be a large maximum drawdown during the losing streak, and of course the recovery factor. This comes back to my point earlier about the usefulness of knowing the recovery factor. The results show that although I would have ended up with almost identical profits, the maximum drawdown would be 5.5% instead of 2.67%. On the surface, it would be easy to say that there is no need for me to use half position size since it does not affect expectancy at all. You might even say that I should stop doing it to cut down on the work. However, this is where the human element comes into play. Using half position size on risky trades makes it psychologically easier for me to trade for 2 reasons. Number 1, it gives me the confidence in taking on risky trades knowing that I would only lose half of my normal risk if it goes wrong. Number 2, it is mentally easier for me to handle smaller maximum drawdown. While both of these reasons have nothing to do with overall profitability, they certainly make it easier for me to fully commit to my trading strategy. This is something that traders who only use statistics don't understand. The numbers don't lie, but they don't always show the full picture. The human element is always the most fragile part of trading. Moving on to the second component of my trade management plan, cutting losses early. This is done by having an early exit key level and a validation test. This is something unique to my strategy, so I would like to explain them first in details. An early exit key level is a price level between my entry and stop loss where I should consider closing out the trade before stop loss is hit. When a candle close hits this level, I must have a very good reason to remain in the trade, otherwise it must be closed out. This forces me to only use price action to make my trading decisions. It is easy to come up with fictional, emotional reasons to remain in a trade. I must have an early exit level in my trading plan before I can enter into a trade. Validation test is a checklist of all the reasons that led me into the trade in the first place. These reasons must continue to be valid after each new candle since my entry. If one or more of them fail, then I must close out the trade. Once again, this is purposely designed to force me to look only at price action for decision making. Validation test shuts out my emotions when managing a trade. Both of these work together to allow me to cut losses early. It's important to know that these rules are set in series, meaning that a trade can be closed out at any time if it triggers one of these rules. I have gone back and reintroduced the 5 break-even trades because they are now no longer break-even. Moving a stop loss to break-even is only triggered if a trade remains open for longer than 72 hours, has not triggered an early exit, and continues to pass the validation test. Now, I have 54 trades, 22 winners, 32 losers, and interestingly, the win rate remains unchanged at 41%. Average win and loss size have both increased, a dramatic drop in average reward to risk ratio, which means that expectancy is lower. In fact, overall profit drops from 21% down to 16.76%. Maximum drawdown is much bigger at 8.14%. And in fact, if I take a look at the account balance, maximum drawdown took place between trade number 9 and trade number 42. That's a long time to deal with mentally. At the beginning of the drawdown, account was up 9%, and at the end of the drawdown, it was almost back to the beginning. The distribution of trades graph will visually show the difference that this has on my outcomes. If there was no early exit, no validation test, then all trades would either hit stop loss or target. Position sizing is still in play, which is why some losses are at 0.5% and also why some winners are at 1%. It is very clear that cutting losses early improves my performance when compared to a set and forget approach. I would still be profitable overall with 16.76%, but the journey would have been very mentally challenging. The account balance graph says it all. I would have to sit through 34 trades while watching the account balance drop slowly from 9% profit down to almost nothing. To summarize the findings in this video, position sizing strategy has no effect on profitability, but it provides mental relief. Cutting losses early makes a noticeable difference to profitability as well as mental stress. Therefore, I will continue to trade the exact same trading plan with no change. If you made it to the end of this video, then I sincerely hope that you can appreciate the importance of doing the boring tasks in trading, such as keeping a logbook and writing down a trading plan. I leave you with a random quote which I think best summarizes my 2 videos. You must do what others don't to achieve what others won't. Thank you for watching.